My guest on the Wealth Managers today, Feroze Azeez from Anand, Rathi. Feroze, pleasure having you on the show today.
Same here.
Have to begin talking about equities. Are you getting any clarity? Because it seems like there's finally that silver lining which is emerging to this dark cloud. You've got crude which has cooled off quite a fair bit. Equity markets are showing you that kind of enthusiasm. We've bounced off quite considerably from the lows. And yes, it seems like finally there is an ease off between US and China when it comes to trade wars as well. Any more clarity on where equity markets may be headed? Is the worst behind us now? Can we safely say that?
To my mind, the worst is behind us because the broader markets have corrected a lot. Okay, if you look at the headline numbers, of course, there isn't too much you can speak about a correction. 11,700 down to 10,500, 600 kind of levels is not a very large correction. But the headline number is good, but there are about 40% of the BSE stocks down 40-50%. So that's a large correction. So I think the worst is behind us, point one. Of course, for the clarity from a long-term perspective to emerge, I think general elections is going to be some trigger which can actually take you the next level, because I think consistency of governance is going to be very critical from an investment standpoint. From a trader standpoint, he lives by the day, but the investor needs to get the trend right, and the trader needs to get the direction right. So I think trends clearly show a bull run to my mind, from a liquidity standpoint, from a earnings standpoint. Also, of course, this news can have some degree of impact on the market.
Feroze, so tell me, how are clients behaving given all this flux in equity markets? Is fresh money coming in easily?
See, I think if you speak from a client's perspective, and if you look at how the portfolios are currently designed, and how do you actually give courage to a person to live the long term by passing through this painful short-term periods which we actually envisage, is to say last 10-year returns are a good indication whether the return is behind us or not. So the average return of Nifty is about 14-15%. Last 10 years has been 8-8.5%. So you can't say the bull run is over, right? Bull runs are those which give you above average returns. Bear runs are the ones which give you below average returns. So it's definitely not that the good portion of the return or the bull run is over. So I think there's a lot to come. Point one. So that's one thing. So we use all these corrections. There have been about 4-5 corrections of 10-12% in the last 2-3 years. We've used each of them to build the portfolios on the equity side, because Indians as investors have significantly less than 50-60% in equity. So you use all these opportunities to get closer to the strategic recommended asset allocation.
So when it comes to equities, is you leaning towards large caps or large mid caps? How is it that you've treated this current decline in the markets?
See, what happens is when you look at the different segments of equity, you have large cap, mid cap, small cap, and then you can categorize them on different sectors as well. But if you look at this broader classification, which in the wealth management industry is very prominent, I would say if you look at the differential valuations between large cap and mid cap for the last 20 years, and take that as your input data to take the decision whether how much to large cap and how much to mid cap. It was clear that the end of the 2017 bull run or the 1 year up move, mid caps and small caps had run up significantly more, because there's always a valuation spread between large cap and mid cap to the extent of 5 PE.
And it was overstretched in 2017.
Right?
Yeah.
So it was clear, that's when we had given a sell call on all mid-cap and small-cap funds to a large extent. So now I think it's exactly the opposite. I think value has emerged because of the collateral damage you've had because of this fall. I think mid-caps and small-caps, especially in the new avatar of the mutual fund definition, mid-caps are no more mid-caps actually. Mid-caps have become semi-large caps. So if I double do my risk mitigation, already mid-caps in the earlier regime were very small stocks. Now the mid-cap definition is anything smaller than 30,000 crores of market cap is called a small cap fund. So you've come a long way. So you can courageously have 40% in mid-cap, because it is actually not pure play mid-cap like it used to be before April this year.
So for someone who manages wealth to the tune of about 20,000 crore rupees in assets under management, what is the ideal asset allocation, if I were to ask you, for someone who's a conservative investor and the other one who is more risk savvy, a more aggressive investor, and who's looking at a shorter time frame, say 1 to 2 years?
See, when you're looking at a conservative investor, we use another instrument called LEAP very extensively. It is long dated equity anticipation participatory securities. There's very little awareness in India, but it's been existing in India for 10 years now. Those help you mitigate risk by hedging the portfolios. If there's a conservative client, I would still put 60% in equity, but use a LEAP which costs you marginally and then still protects your downsides. Okay, on the NSE platform, you are able to buy a 3-year put option, which is a LEAP, where Anand Rathi actually has the largest open interest. So that's what I would do with a conservative client, and spend that little money so that he can have 365 days of sleep and not be too worried about what the newspapers have to read the next day. If it's an aggressive client, I will probably save that cost of protecting yourself, because when you're putting large monies in debt, there is an implied cost. Because if you're going to grow your money at 7%, 8% and say that there's no cost, the cost is 7-8% of opportunity. So I'm better off spending 2%, 1.5% per year to protect the downside and not be in plain debts for long-term monies. If your money is 2 years, then it's a different story. If it's generational wealth, an advisor only thinking of protecting money by using the conventional ancestral method of putting money in debt and not looking at more contemporary methods like a LEAP would not. So to summarize, 60% in equity but hedged, 40% in debt would be my allocation.
For the conservative guy. And for a more aggressive investor?
For a more aggressive investor, I would still have 60% in equity, 40% in debt, but the equity will be unhedged, because he would have the appetite to go through the short-term volatility so that he can realize the long-term benefit which he intends to realize. But after an asset allocation, a vehicular choice is going to determine a large portion of the return as well. So we put in conventional products, 60-70% of the money is going to be in mutual funds, 30% goes into structures. These vehicular selections would actually change the expected return dramatically.
I'll come to that in just a bit as to what these structured assets are, but I'm a little surprised there's no gold, there's no real estate, the traditional other asset classes.
See, I think wealth management industry owes it to the Indian community to not market these two instruments, because why does it happen that way? There's data to say 60% of people's money is in real estate. Okay, you might, if you say zero, we might actually come to mid ground of bringing down the real estate asset. Why? Because real estate as a tangible asset, of course, has some degree of comfort, emotional comfort, but it is not going to throw up a large yield. Like when you buy equity, the companies are earning money. There are lakhs of people going to work to create value, right? When you've bought an apartment, the builder is not going to call you after 10 years and say, I give you an extra bedroom, right? Unless you go into redevelopment, that's a separate. But you're getting dividends, you're getting earnings. Gold, unfortunately, I think we have fallen in love with gold for years, and that's in dollar terms has generated negative return for 25 years. Okay, but in India, when you look at gold, you are seeing it with a good jacket of dollar, and dollar is appreciated, is why gold is looking pretty in Indian rupees.
But purely because of that, the dollar may appreciate a little more, the world is getting a little risk averse. Do you not believe that maybe a tiny portion of your portfolio could be exposed to gold, maybe as minuscule as 5%?
See, firstly, any decision you take as a principle of treasury management or wealth management, take it decisively. If you're wanting to hedge against risks, 5 can never hedge 95, right? 5 can never hedge 95. So you'll have to have substantive portions if you go that path. So that's point one. If you have to get dollar exposure, gold is still not a good asset class, because there are Indian international funds. If you have an objective of getting your child educated abroad, or if you're a traveler and you want to have dollar exposure for that portion of the gold, that portion of your money, then you can use domestic international funds. You automatically get a dollar exposure, and gold is a no-no in my opinion, because it will not be able to beat inflation, at least Indian inflation.
Right, Feroze. Hold on to that thought. We're going to take a very short break on that note. But when we come back, we're going to talk about alternative investment funds. What else is Anand Rathi focusing on when it comes to managing your money? back with the Wealth Manager, still in conversation with Feroze Azeez. We've talked about his views on equity, gold as well as real estate. But let's find out what else looks attractive to him at Anand Rathi. Feroze, you know, this has been a question on our mind because what domestically has really derailed and spooked the markets has been the IL&FS crisis. You're still trying to figure out exactly what happened. I mean, overnight a company from a AAA rating goes into junk or default. How is it that you explain that to your clients? Because I'm so sure they must be baffled.
Yeah, of course. I think it completely shakes up your faith in the system.
Absolutely.
I think it's very evident that rating agencies, if I have to be very blunt, have not done a great job predicting credit defaults. Because fundamentally there's a problem. Okay, if a corporate is paying and getting themselves rated, a third party using that rating to make investment decisions for hard-earned monies of decades, maybe I think there has to be some degree of homework done by the advisor, if not the client. Okay, when we analyzed 20 companies which went default, a significant portion, 60 to 70% of them were AAA rated just a year and a half before they went default. After this, you have to conclude, data clearly helps you conclude that rating is not a good measure of credit risk. So we at Anand Rathi started using another instrument which was discovered, another measure of credit risk which was discovered way back in 1968 called Altman Z-score. Sounds more complex but very simple. You can get somebody to compute Altman Z-score. They have proved to be significantly better predictors of credit default. If I look examples, any score on Altman Z-score for a manufacturing company greater than 2.5 is great score. Right? Companies, I will not name it, one of the companies which went default was AA rated for 4 consecutive years, went default, but the Altman Z-score was 2.89, which was good.
I think we can very well guess which one that is.
Yeah. 2.89, then went down to 1.24, went down to 0.24 and then minus 1.29. So if somebody would have based their decisions on this parameter, not on the rating, would have exited much before the pain actually arrived. So point one I'm making is, if you have a large portion as an Indian in debt, not using the other measure when one measure has time and again proved wrong is not good advice or management.
Okay, so are there other companies which do not match up to the Z-score? What I'm trying to ask, and fearfully asking, if I can use that terminology, is are there more IL&FSs in the pipeline?
Of course, you would see a very big divergence. So we analyze several companies and try and see if there is a dichotomy between rating and Z-scores, and you'll be surprised that 30 to 40% of them, which are AAA, show another story on the Z-score parameter. So it's important, see, in a show like this, it's very important for us to make people aware that you have to use different harmony available to treasury managers to manage your money, and you can only create curiosity and can't create second decimal understanding of it. But it's important, if it's your money, you will have to understand risks and measure it. If you don't know one measure, if you know that one measure has disappointed you, you will have to learn from these episodes and progress.
So Feroze, what is it that you would say is your niche as a wealth manager? Because in my conversation with other wealth managers as part of this series, I also gather that it's not about plain Jane investing in equities, large or mid caps or small caps or what have you. It's about what else can you provide beyond the realm of what just about everyone else can.
Correct. We feel very passionately about this, creating a niche for yourself. But I think on the contrary, in India, simple instruments have delivered client expectations. Sometimes you're creating over complex products to just quench your thirst of commissions. I'm being very blunt about it. Okay, because after 10-15 years of innovating in this industry, I think innovation on PE, alternate funds, AIFs, IPOs, pre-IPOs, all this started way back in 2006. So there's 10-12 years of good data to say that what's gone wrong. Simple mutual fund for the same period has delivered 16, 17, 18%. And clients are happy with 14-15. So you have to stop innovating sometimes, because from business,
keep it simple.
Keep it business reasons. If I have to expand my business, I will have to innovate. But if I have to only focus on clients' returns, and client is happy with 12%, but you're still innovating when the simplest products are delivering 14-15%. So that's point one I'm making. Point two, if you have to bring something innovative, then it has to be a complementary instrument. You should have a plan A, which is a mutual fund. If plan A fails, what's your plan B? So if you have a thought process of plan B, then you know that even if I go to a restaurant, for example, I have a plan A. If I don't get a reservation, I will go to a plan B. But most portfolios are designed by managers thinking that the advisor will always go right. It is not going to be that way, right? Because there are going to be several newspapers which will read several things. So you have to assume that a certain portion of your money has to assume that if your advisor goes wrong, how does your client still stay afloat? That's where we introduce structured products after a large debate of what should be the plan B. That's where we do structured products, and we are one of the largest gross mobilizers. There are other.
What kind of structured products?
Structured products are those products which say, for example, if Nifty delivers only 2% a year and does not deliver the 10-15% a year, you still make 14% per annum.
And how do you do that?
Okay, it is a combination of debt instrument and a derivative instrument combined in a certain proportion gives you this payoff. Looks startling enough, but in a high interest rate economy, which we are in, and a high volatility economy, if you get these two inputs to a treasury manager or a trader who creates this product with high interest rate, high volatility, you can combine and get a payoff like I illustrated. 2% growth on Nifty gives you 14%. Then no more than 14. That's your drawback, right? You will never make more than 14, but 14 is good quality return. And if the market runs up and you have a bull run like 2003 to 2007, then mutual funds will do the trick for you. Otherwise, this will be a fallback option. So how do you create them? Debt and derivative in reasonable proportions can get you this output.
Okay, so if I had to ask you that what is the ideal percentage allocation between debt as well as mutual funds in the current day and age, what would it be?
It is 65 in mutual funds, 30-35 in structures. And we have not given to our customers for the last 6 years any other product. And my clients' entire AUM, we measured what is the return all the money has made. And you'll be surprised, it's stupendous return. If my entire AUM, no wealth manager actually ends up measuring it, right? You have to measure whether all your AUM has grown at a good rate, not just on return, but on risks. So we got it audited. And if my clients are making 14-15% return on my entire AUM, so I've banned these other products for the last 6 years and my clients are happy.
You know, Feroze, when you talk about wealth management, every client's needs differ. Someone wants to retire at age 35, the others at regular 60, and some are looking at just pure estate management, which I believe is also a niche for you at Anand Rathi. Tell me a little bit more about that.
See, asset planning, estate planning is a process of transmitting your money to the next generation. See, one thing in common all of us have, and all our viewers have, is that we all have a finite life. None of us have an infinite life. So 100% probability event. Of course, we don't know the date when that happens. Not planning for that adequately is not good management. So if you call yourself a wealth manager, then you are duty bound to pressure the client to get this in order to the second decimal. India is very complex when it comes to estate planning. We would be one of the highest complexities in transmitting my money to my son, for example. So it is a wealth manager's job to do the clerical nitty-gritty work, because if you don't have a registered will, somebody contests it on the basis of it being the last will. People contest it on the basis of the person's sanity. So if you attach a psychiatrist certificate, solves the problem. So such nitty-gritties, somebody has to do that dirty work of actually doing that. And I think that's the most important thing. You have to grow your money, protect it from encroachment. If there are litigations, you still should have some money to live your livelihood. That's called ring fencing. And then when you've grown your money, protected it, the next last step is to give it away to somebody who's going to be the next karta or the driver. And that process is complex enough that it requires.
In the break, you were also talking about the emphasis of risk management. Is there a clear-cut mathematical formula which helps you calculate that?
Absolutely. I think risk, like you mentioned, is something which is less understood. See, when you open a book of finance, it says expected return and risk management. It clearly indicates that returns can only be expected. Risk is the only thing you can manage, right? Returns can't be managed, returns can be expected. If that's the case, you will have to have emphasis in risk management and measurement. To manage anything, you have to measure it first. Statistics has 4-5 very strong measures of risk. Treasuries measure risk second decimal, probabilities of losing money, losing capital, losing return. So the most common method is standard deviation. Okay, it tells you what can be the deviation from the expected outcomes. If you're expecting 15% return, if it was a fixed deposit, you will make 15% return if the bank is not bankrupt. But if it's equity, there is a range in which you might end up. Standard deviation helps you find out that range. If 15 is your return expected, and if your standard deviation is 5, that means the first range, not all the ranges, first range is between 10 and 20. There is a high probability that your range will be between 10 and 20. 2 standard deviation range is 90% chance that you will be between 5 and 25. So measuring your portfolio standard deviation is your duty. It is not something good to know, because that's the only thing you can manage. Now, to give the viewer a benchmark, Nifty has a standard deviation of 13. If your portfolio shows up lower than that, then you can be relaxed a little. But if it's more than that, you need to be worried. I have seen PMS portfolios with 28 standard deviation, and the client doesn't even know that the standard deviation. Stocks can have 70% standard deviation.
Yeah, of course.
Right? PMS's portfolios have 28 standard deviation. And if you,
what do you do if you suddenly find out one day that your portfolio is sitting at 28% standard deviation and it runs such a large risk?
Right. So this is because I was meeting a person and a client. Okay, look at the psyche. He says risk is the backbone of my strategy. Then I said, then if it's your backbone of your strategy, let me measure it. Then I measured. The guy said I'm conservative, but his standard deviation came as 22. Right? Then your portfolio and you have to speak the same language. It's your money and it's you who's speaking. So they need to be married. Then there is some redesigning needed. Like we mentioned, Leap. Leap can bring down standard deviation. A structure product standard deviation is 4, the one which I mentioned. It's not 13. So if I infuse instruments which have lower standard deviation and opposite correlation, then your standard deviation drops. So your portfolio design has to take both sides of the coin, return and risk. And by this show, we can only create curiosity and the need to know it better, because that's the only variable you're going to manage anyway.
Okay, so looking at the market construct right now, where would you say lies the opportunity for biggest alpha and across all asset classes? Because 2017, at least when it comes to equities, got you a little greedy in terms of the kind of returns that you can generate.
Correct. To make alpha, I think alpha on the equity side, equity is going to make money in my opinion, because if you understand the trend, it is clear that the kind of liquidity which is domestic liquidity which is going to chase Indian equity is going to be enormous, because 10,000 crores is going to be spent on investor education in the next 10 years. That's a lot of money, right? And only 2 crore investors are there, and that can easily go to 10 crore, 15 crore investors with this kind of commitment on capital, unless the rule changes by SEBI. So the trend is clear that the last 10 years of capital market bull run was funded by the Goras, as we call them, in a broker market. But the next 10 years is going to be funded by the lower strata of the Desis. So if that's going to happen, by design, unfortunately or fortunately, the new regulation of mutual fund concentrates this money largely to the top 250 listed companies. So there is going to be a huge P rating driven by liquidity, not in the 3, 4, 5, 6 month period, but in the 10-year period. You will see a large re-rating, because this kind of money chasing only 250 listed companies largely in a country of this magnitude and size seems like a concentration. So that's where the alpha is going to come from.
Okay, great speaking with you. Glad that you could
Ayesha.
take time out and speak with us
Ayesha.
today.